Well, what a difference a week makes. From plus into the 40s to minus 10. It was definitely a risk-off week. And with that close on Friday, we should be expecting some more volatility and downside over the course of the next several weeks. The daily model is turning over again. It's still positive, but I don't doubt that a few days of scores in the negative camp will probably give it another sell. The weekly model is probably another couple of weeks away from a sell, and the monthly model is definitely over 2 months away from a sell, at least one. At least the whole of August. But there is a big difference in score, and I've been saying that calls are the way to go as opposed to outrights, and it has been proven right. If we look at deviations, we shall see that we are now right on top of the middle line. We have lots of room up and down, and therefore volatility is likely to be quite elevated. I would have thought that at some stage, after maybe a small bounce, we do go down towards the middle, but we will have by then a very much narrowing deviations line. So I definitely expect this 2864 level down here to be tested at some stage over the future. If we look into the sectors, we shall see that the energy is very low and very near its bottom, and we have the telecoms coming down as well. I expect a bounce at some stage here, but the ones that are not supportive are going to be the XLK, which still has room to fall before a bounce, and even XLF, which is now, because of the expectations of what the Fed will do, likely to be in a narrowing range for quite some time. All this, given that these are the largest sectors in the market, tells me that we have very little power to go significantly higher for the foreseeable future. And the Blue Angels tell their story. Time 17 is rejected. I would have thought that at some stage we have to test and go down to time 16, which is around 28.30, 28.40, 28.50, just below that all-important 28.64 level, which I think is going to be very good support for a number of weeks. So I would say that the market would be fairly priced around that 28.64 level for the time being until new information comes out. You have to remember that the fact that bond yields are coming down so significantly is supportive of the equity market or certain sectors of the equity market, and therefore not the whole of the S&P sectors is going to come down at the same speed or even come down at all. In which case 2864 or this time 16 Blue Angel should be very good support for a while, much like it was in this period here when the time 16 line was ascending. At the moment it's pretty flat, but I would have thought several weeks of trading around the time 16, and then we make our minds up. Well, the picture in the 2-year is not very pretty. We got just about to 196, 197, and then straight down. Maybe a couple of days of hesitation, but I wouldn't put too much money on it. Somewhere around 178, 179, and then straight down. I would have thought 150 now has to be an objective, and following 150 we're talking about the ultimate level that I'm looking for, which is 130. So very, very much a picture of a declining yield environment. Things look pretty dire in the 5-year as well. I would have thought this 161 level is bound to be tested, and after that we have 145. If we go back in time, we can see that really the all-time low is just below 1, around 90. You know, it's very tough to argue against the market going there. But certainly this 161 level gets filled, and we do have a gap here somewhere around the 152, 153 level. You know, that gap looks like it will be filled at some stage too. 153 in yields in the 5-year. That really does not bode well for XLF because unless the Fed gets a move on and really starts cutting rates by 50s, this is not going to sit well with the banking sector. Having a negative yield curve in the sector where they lend is not good for it. Therefore, for the time being, certainly completely avoid XLF. This is now a weekly chart of the 10-year note. You can see that we have this 169 level here, probably will be reached over the course of the next couple of weeks, and after that all we have are the all-time lows around the 137, 138 yield level. Those cannot be put out of the question either. Very much a a falling long-term yield environment. Nothing to be said about it. On any retracements, you have to buy calls in 10-year futures and 5-year futures. And finally, TLT. What to say? Wow. It is just going up, isn't it? First the last resistance is 137, and then you have the all-time highs around the 144 level. Not a pretty picture. Another leg higher. We should get to at least a parallel of this line around 140, and that is why I still think that equities have some room to fall, because otherwise the 30-year wouldn't be going up, and nor would the 10-year. It never got to the level that I really wanted to buy, and that's a shame. The 137 level is going to be tough to break. I would have thought a couple of weeks here, and then we go back up. Very strong market, very strong market. I would not try to resist it very much at all. Well, the yield differential between the German Bund and the 10-year note tried to close below 245, but on the week it really went up to 233. Now I would consider that a move to 221 or even 215 is quite likely, and that is why the DXY is not making new highs, why Euro USD is sticking to that 111.08 level. This looks very much like a bull flag. The continuation should give us a weaker dollar for the next couple of weeks, but once it's reached that level, you would have thought the dollar would start actually strengthening again against the euro. The big movement in the currencies is in the risk off. You're talking about the Swiss, you're talking about the yen, and if the Swiss and the yen are strong, that is holding back DXY, but the euro is also suffering. So you have to really wait for this move to be over, for us to be around the 215, 210 area before you can look for a significantly lower Euro USD. And here we have a weekly chart of Euro USD with this all-important 111.08, 09 level. It closed right on top of it. It's pretty amazing how the markets tend to go to these very important levels. And here we have a potential divergence in the stochastics. Market makes new lows, stochastics don't turn up. Bam, 123, 125 stops everyone out, straight back down. Really, the play is not the euro. The play is euro on the crosses against the yen. because we are in a risk-off period. So, at some stage the dollar strength will return, but probably not for a week or so, while they stop everyone out of their short euro positions against the dollar. DXY, same story, but slightly more pronounced. We could easily come back towards the 97.50 level and even 96.50 just to annoy people, and then go again. If we were to turn this into a weekly chart, we will see that the picture here looks actually quite a bit better. We shouldn't fear a return to 96.50. We should see it as an opportunity to buy, and the market is definitely getting ready for some moves higher here, I would have thought. I am far less afraid of the dollar than I was before. Moves down to 96.50 should lead to bounces back up to 100. It is just temporary, I think. It could get uglier, as I've just explained, and why. This is being led by the risk-off currencies of Swissie and yen. I wouldn't fight it for the time being until the equity sector stabilizes. Well, what I was afraid of last week happened. We're going to look at the S&Ps from 60 minutes all the way out to 1 month. Now, bounces should be actually bounded by the 200 period moving average, which will come in some around the 0.618, which is right this level here, around the 29.75 area. I don't see the market going higher than 29.75. If we now first of all look at it daily, we will see that we are now through the Bollinger Bands and therefore due a bounce. But this area here between 29.75, just like in the hourlies, and 29.82 is going to be very good resistance and a level to sell. We could be doing an A, a B, and the C back down to the, say, the 0.618 retracement and this gap fill here, which is 28.43. So just below the very important 64 level, just spike it for a bit, get people all bared up, and boom, straight back up. So, I would have thought certainly we do not sell it into a hole anywhere near 28.64, but we do try to resell these levels up here. We had a wonderful week being short. There's no point being too bearish. A squeeze at some stage will happen. Now, when we think about the likelihood of yields coming off, as I shown earlier, it is very supportive of certain sectors of SPX, not NQ, but SPX, yes. And therefore, to expect SPX just to collapse, I think, is a pipe dream for a long time to come. I would have thought that the best you're going to get in terms of reason buy is that 28.64 level. I would be surprised that if in a couple of weeks' time we are below 28.64. So if we then continue on to a weekly chart, we will see that there is considerable support above 28.64 from the middle Bollinger Band, which we nearly touched around 2900. It'll be slightly higher next week, and then 28.85 or something like that, which is also an important level. This tends to catch the red line tends to catch quite a few lows, and after that, in any case, we will have very good support around this area, 2800. So really 28.64 to me is a reasonable level to cover all shorts. Certainly anything that is sold back up, as I showed earlier, in the 2970s, really I would not want to trade shorts aggressively below 2864. And if we now look at a monthly chart, it is pretty obvious really that this red line has caught so many. I mean, it never really closed below it, and when it did, it just traded around it. So, you know, this comes in at 2850 something. So 2864 really for shorts is all you can hope for. After that, we have the 2790 middle Bollinger Band, which has caught it many times and caused quite strong reactions. So if you cover at 2864, chances are you will see it again. It might take a month, but you know, I think trading aggressive shorts below 2864 is not something that I would recommend now. The one which is still very dangerous is NQ. NQ now could easily come down to 7300. I would avoid NQ. I see no reason to be aggressively long of it. As I've said for quite some time, I don't see the value in NQ. It is quite dangerous. I might change my mind when facts change, but I don't see the facts changing for a while. 7300 written all over it in NQ. As always, the daily VIX gave us a very good warning signal, and it's always worth paying attention to what it's doing. Anything above 20 probably leads you straight up to 23. The market is in a bad technical position in VIX, but I would have thought it's more likely to trade sideways down even to 1627, which would be a decent buy, or certainly 15. You can see this bundle of moving averages here. So really the VIX has to fall below 15 to have sustained support for XPX. I would have thought the VIX could get there if we get to 2970 to 75, as I showed you, but there it's a good buy, i.e. the S&Ps are a good sell. We shall definitely rebuy puts if the market gets to 2970 something, because they should be considerably cheaper, and then I would have thought a nice move back up to this kind of level, 23, and that will have given us a nice ABC in the VIX, and also a nice ABC in SPX, as I showed you earlier. Another reason to think that we're not just going to fall apart in S&Ps, but we are within, I don't know, 2.5% of a reasonable bottom level, certainly for a decent trade of 2864, is the picture in the European DAX. You can see this confluence of moving averages all the way from 11,700 with the Bollinger Bands down 11,500. So this area is going to be very difficult to break, and we also have this gap down to around 11,500. I still have a whole load of puts which I bought up here and which I'm definitely going to sell when we get into this area. You know, and even past that, 11,430, 11,370 is such an important area that I don't think it goes through it in the next couple of trading weeks. So have these levels marked. Anything around 11,600 is a call spread level for probably a move back up to 12,000. So that to me says that you know, it's not the end of the world in DAX either, and therefore not in S&Ps. I wanted to remind you of this spread relationship chart between the S&Ps and gold. It is pretty bearish, isn't it? I mean, we do now know absolutely where the stop has to be if you are long of gold, short of S&Ps. It's this 2230 level. You have the 200-day moving average, you have the 50-day moving average. It's tried it so many times, rejected every time. Boom. 2087 is going to be such an important level, and I'll definitely keep you up to date with developments here. But for the time being, notwithstanding small corrections, it looks like gold is a better buy than S&Ps. And here we are with a weekly chart of gold. It's doing nothing wrong, is it? Basically trading between 14,617 and 1458. It's closing right at the top of that band and looking to break higher. Now, if it does, really, even if this is an ABC, the minimum target is going to be the 1520 level and then 1560. So those are the minimum levels you would expect on a closing break above 1458. Quite some room, and as I showed you, it is definitely in a trend higher, longer term trend higher, medium term trend higher against the S&Ps at the moment. It could be quite possible to see that very important level I just showed you in the spread when gold is somewhere around the 1520 level and the S&Ps are somewhere around the 2864 level, and then things turn round with gold being sold and S&Ps being bought. Finally, onto the biases for next week. As I've shown you, 178 is now going to be good resistance in the 2-year note, and I expect the 150 level to be hit pretty soon. Fives, 161 and then 146 are the targets. Anything around 173, and we need to buy some calls. This is headed to 169, the 10-year, and TLT, it's headed to 137 and then possibly all the way to 143, 144. I've told you what I think here. That spread should now come in quite significantly to around the 210 area. And here we are, SPX, anywhere between 55 and 82 is my sell area, down for a move down to 2864. And if the worst happens and it goes through there, 2790 to 2770 is going to be very good support from the monthlies and the weeklies, and I expect to move back up towards 2864. NQ, leave it well alone. RUT, leave it well alone. VX, I think, beyond 20% we get to that 2324. 1625 is support, and as I showed you, really 1450 or so is going to be a great buy. European equities, I showed you the DAX support between 500 and 650. That encourages me to think that we will not break this 2864 level in a hurry. And DX, unfortunately, as I showed you, the interest rate differentials are not supportive of the dollar at the moment. The 10-year note, the 30-year note are all falling faster than their European counterparts, and therefore you would have thought there'd be a period of Euro USD outperformance, and therefore DXY cannot really move. I showed you the levels. 9650 is still very key, and I would have thought if we get back there, it's a great buy. As I said, people are getting whipped around and getting very hurt. I think here we don't need to chase anything. We have pretty well defined levels, 2864. We have the levels where we will try shorts around the 2970, 80 area. Really no need to chase anything. I think this is going to be, there isn't going to be a panic here because lower yields, and yields are definitely going lower, are supportive of many equity sectors, and therefore the likelihood of a complete breakdown in equities is rather low. Thank you very much indeed, and tweet you on Monday.